You're sitting at your desk right now. Maybe it's Monday morning, maybe it's the middle of the week, and you're already counting down to Friday. You've got a decent job, the salary isn't bad, you pay your bills, you keep up with life, and somewhere in the back of your mind there's this number that keeps showing up, $1 million. And every time it shows up, you push it back down. Because that's not for people like you. That's for people who got lucky, or started young, or had parents who handed them a Roth IRA at 16. You're just a normal person with a normal job and a normal life. And yet, you're still here, which means some part of you isn't ready to let go of that number just yet. So let's talk about it honestly. Because here's what nobody says out loud. Most millionaires in this country didn't inherit it. They didn't launch a startup. They didn't win the market on GameStop. They built it, slowly, quietly, while working jobs just like yours. And the reason you don't know this is because the people who did it aren't making YouTube videos about it. They're just living their lives. So today, you're getting the version of this story nobody told you. But before we get to the good part, I need you to sit with something uncomfortable for a minute. Think about the last 12 months of your financial life. Not the highlights, the reality. The $14.99 subscription you forgot about until your bank statement reminded you. The month you said, I'll start investing next month. And then next month turned into 6 months, turned into almost a year. The raise you got in March that disappeared by June and you genuinely couldn't tell anyone where it went. The credit card balance you paid down and then quietly ran back up by December. These aren't character flaws. They're patterns. And patterns have a cost. Here's how that cost actually adds up. If you're spending an unnecessary $300 a month, and most people in their 30s are, across subscriptions, food delivery markups, and impulse spending, that's $3,600 a year. Over 10 years, not invested, that's $36,000 just gone. Invested at even a modest 8% average annual return, that $300 a month becomes over $54,000 in 10 years. Not because you're a genius, because you let time do the work. But you can't let time do the work if you keep giving it nothing to work with. And this is where most financial content stops. It says spend less, save more, and acts like that's a revelation. It's not. You already know that. The question is why you're not doing it. And the answer isn't laziness. It's something deeper than that.
Nobody actually taught you how money works. Not in school, not from most parents who were just figuring it out themselves. You learned to earn money. You were never taught to think about money as a system you could plug yourself into. And on top of that, every single day you are surrounded by an economy that is specifically designed to keep you spending. One-click purchasing, 12 months, same as cash. Buy now, pay later. These aren't conveniences, they are behavioral engineering, and you've been navigating it without a map.
Here's the other thing that happened without you noticing. Lifestyle inflation. You made $45,000 5 years ago, and life felt tight. You make $68,000 now, and it still feels tight. The number went up, the feeling didn't change. Because somewhere between those two salaries, the baseline shifted. The apartment got bigger, the car got newer, the dinners got more expensive, and every single one of those upgrades felt completely reasonable in the moment. Of course, you moved to the nicer apartment when you could afford it. Of course, you traded up the car. The problem isn't that you did those things. The problem is that you did them automatically, without asking whether they were moving you forward or just making the treadmill spin faster. This is the invisible trap. Not bad decisions, automatic decisions. And this is where everything starts to change. Here's what no one tells you about building $1 million on a normal salary. It has almost nothing to do with how much you make. It has everything to do with the gap between what you earn and what you keep. And that gap is a decision, not a destiny. Let me show you how this actually works in real numbers. The average household income in America right now is somewhere around $75,000 a year. If someone in that household commits to investing just 15% of their gross income, that's roughly $937 a month going into an investment account. If that money is invested consistently in a low-cost index fund, we're talking something as simple as a broad market ETF tracking the S&P 500 and earns the historical average of roughly 7% annually after inflation, here's what happens. In 10 years, that person has around $155,000. In 20 years, $490,000. In 30 years, over $1.1 million. No inheritance, no windfall, no secret strategy, just consistent behavior applied over time. Now let me break down the 3 principles behind that number, because I don't want you to just accept it. I want you to understand why it works. The first principle is what I call the velocity of consistency. The market doesn't reward genius, it rewards patience. When you invest every single month, regardless of whether the market is up or down, you're doing something called dollar cost averaging. You buy more shares when prices are low, fewer when prices are high, and over time, your average cost per share drops naturally. The people who panic sold during 2020 when the market crashed 34% in 5 weeks locked in those losses. The people who kept buying through the crash quietly doubled their money in the 18 months that followed. Consistency isn't a nice trait, it's a financial weapon.
The second principle is the true cost of waiting. Every year you delay is not just 1 year of returns you miss, it's the compound effect of that year applied to every year that follows. Let's make this concrete. 2 people, both investing $500 a month. Person A starts at 25, person B starts at 35. By 65, person A has approximately $1.3 million. Person B has about $566,000. Same monthly contribution, same rate of return. A 10-year head start produced more than double the outcome. That gap isn't math. That's what it costs to say, I'll start eventually.
The third principle is the account structure premium. Where your money lives matters almost as much as how much you put in. A traditional 401k gives you a tax deduction now, letting you invest pre-tax dollars. A Roth IRA taxes you now, but lets your money grow completely tax-free. The difference over 30 years can be tens of thousands of dollars purely from tax treatment. If your employer offers a 401k match and you're not capturing the full match, you are leaving free money on the table. That is not a metaphor. A 50% match on up to 6% of your salary is a guaranteed 50% return before the market touches a single dollar. There is no investment on earth that gives you that. And this is where I want to be real with you, because I think you deserve that. Most people will watch this video, nod along, feel genuinely inspired, and then change nothing. Not because they don't care, because the space between understanding something and actually doing it is where the real battle lives. And that battle isn't won by motivation. Motivation fades. It's won by systems. Automatic transfers on payday before you have a chance to spend the money. Employer contributions set up once and left alone. A Roth IRA with a recurring contribution that happens without you having to decide anything. The goal is to make the right behavior frictionless and the wrong behavior inconvenient.
Your lifestyle right now is in large part a product of someone else's marketing budget. The streaming services, the food delivery apps, the fast fashion, the financed furniture, these are not expressions of who you are. They are sophisticated systems designed to capture your paycheck before you can redirect it toward your future. That's not a judgment, that's just the game as it's currently set up. And once you see the game, you can choose how to play it.
So here's where you are right now. You're at a fork. One path looks like the next 5 years looking almost identical to the last 5 years. Income goes up a little, spending adjusts to match it. The number in your account moves slowly if it moves at all. The other path is boring in a way that people seriously underestimate. It's automating $400 a month into a Roth IRA. It's capturing your employer's 401k match. It's sitting inside index funds and not touching them when the news gets scary. It doesn't make for a great story at dinner, but in 25 years, the person who walked that boring path is sitting on the kind of financial freedom that most people only read about. The question isn't whether you're capable of this. You absolutely are.
The question is whether you're ready to stop treating your financial future like something that's going to sort itself out. Because it won't, not by itself. But it absolutely will if you decide, not someday, not next month, but right now, that you're the kind of person who builds. So I want to leave you with this. If you stopped lying to yourself about money, about what you actually spend, about why you keep delaying, about what you could genuinely do with $300 less per month of friction, what would the next version of your financial life actually look like? Think about that. Seriously. Because the answer to that question is probably the most important financial plan you'll ever make.